Inflation is something that in extreme environments, fiscal and monetary authorities, especially when working together, can generate quite well if they get to the point where they need to. And we got the catalyst the next year in 2020, and ever since then we've been off to the races in terms of the amount of monetary expansion at the broad layer, not just base money, but broad money expansion, more money in people's pockets. Then combined with various inflationary forces like energy crisis and kind of a reversal of some of these offshoring globalization trends, which keeps downward pressure on labor prices domestically. And so when bonds are yielding next to nothing and inflation is reaching 4-decade highs, I think it's natural for those yields to want to push up, because they're even after this crazy sell-off, those yields are still below at least current inflation. Now they're above forward inflation expectations, but forward inflation expectations has not been particularly accurate in recent years. And so I think it's a combination of, one, trying to deal with the inflation, and two, some of it's mechanical. Some of it is, as central banks are trying to fight that inflation, they're trying to not buy as many bonds or even let some bonds mature off their balance sheet. And so now you have basically oversupply of bonds, large deficits, and then you have some of the biggest buyers not selling and then not buying. And then when you go to some markets, like for example, the US Treasury market, foreign countries use those treasuries as like a ballast for their own currencies. So when the dollar is weak, they're generally accumulating treasuries. And when the dollar is very strong, like it is now, especially compared to many other developed market currencies, so ironically, some of the emerging markets are actually holding up better, but the dollar is very strong relative to a lot of these other currencies. And so what they do is, first, they stop buying treasuries. And then two, they can start letting treasuries mature off their balance sheet. They can sell some of the shorter duration stuff that they have. And if it gets bad enough, they could even sell some of the long duration treasuries. And so you have a lack of a foreign bid for treasuries. And so basically in this environment, it's a very toxic combination for the sovereign bond market. I would say that, again, going back to 2019, I was saying that whatever excess there is in equities, I was more concerned about the bubble that's in sovereign bonds. Because when you have, for the first time ever, like negative yields, or in the United States, like record low yields, and I was at long horizon, I was seeing inflationary pressures start building. It's just a toxic combination, and it's funny, it surprised even me with how rapidly it happened. And part of that is because we got certain catalysts that they were even more rapid than we could have gotten, like again, the energy crisis in Europe and the war in Europe. The treasury market is not at panic yet. So an example of not even panic, just I would call it broken, right? So broken was March 2020. That was broken, which is basically you had this global trade came to a halt. Cash flows of companies dried up. They still have dollar-denominated debt. There's a huge bid for dollars globally. You had a dollar spike, and a lot of countries sold treasuries to get dollars. And so you had basically off-the-run treasuries literally went like no bid. It just was like a broken market. And so that's an example of a market breaking. But of course, there's so much breaking back then, no one was really panicking about treasuries. They're like, the Fed's going to fix this. But it was a broken market. And another example of a broken market is what happened to the gilt market, where you got yields really spiking, and then you would have had a cascade of pension liquidation. Each one sells those gilts, and then the next one has to sell because the prices got even worse. So you have this vicious feedback loop that basically breaks everything. So we're not there yet in the treasury market, where it's ugly and it's disorderly, but it's not outright broken. And I think part of it's because we got there at a much slower pace. So you can see on the screen there, the spikes that happened in March 2020, that was just a vertical straight line up. Whereas what we're seeing now has taken place over the past year and a half. And so it's been this slow grind towards worsening and worsening volatility and worsening illiquidity in the treasury market. And it's just causing problems, but it's not something that they have to put out a fire this week. So I think it's pretty clear that they're going over 4. I don't have a strong opinion on exactly where they're going to get. If you asked me a year ago, I would not have guessed we're this high by this point. So we've already gone up quicker than I would have guessed. So I would be less prone to try to make a prediction there, other than to point out that there's nothing really stopping them from getting to that point in this environment. Because as long as they keep the treasury market functioning through the other tools we just discussed, those other things can spike pretty high until they manifest in an obvious recession, right? It takes time for unemployment to happen. So the Fed's mandate is basically they want low long-term employment and they want price stability, which they define as 2% average inflation. And looking at those metrics in the way that they measure them, of course, people can debate whether or not they're measuring them properly, but they define how they measure them. And Powell has a clear mandate to push up unemployment and push down inflation. And that's not going to happen next week. It's not going to happen next month. It's going to take time. And there's an argument that they've already done enough and that they were already on a recessionary path now, and that maybe they should let some of the existing monetary policy take its toll. On the other hand, you have things like the Taylor rule or other metrics saying you should be at like high single digit rates. You should be above inflation. That's how they would do it historically. Of course, that doesn't take into account the fact that most debt is insolvent at that point, including the public sector, right? I think we're in an environment where the rates question, I think he's got some degree of flexibility with, as long as they put out the fires. Because if you spike rates super high, it's likely to be good for the dollar, which is likely to continue in more forward selling of treasuries. So then the question becomes, if you're supporting the treasury market, if you're doing one hand and then tightening on the other hand, then that gives you more leeway to tighten with your one hand, right? And I think that it's unclear how far they're going to get, but it does take time for some of these more obvious recession indicators to manifest. So I wouldn't be surprised if they get some pretty hawkish rate policies. We've been in a declining PMI environment, so economic decelerating environment, since 2021, towards the end of the year. And so either way you look at it, we're in a decelerating economy. And we had 2 quarters of negative real growth, third quarter is looking positive, but I think the general trend is still negative, especially because the things I said before, these existing high rates, let alone if they go higher, but the existing high rates, more and more debt's going to start refinancing those higher rates and put pressure on corporations and different types of consumers. We're seeing kind of weakness in auto lending default rates. We're seeing still, I think PMIs are still headed down longer term. And there are things that could change my mind. If you were to have some sort of big pivot and a weak dollar, that's a type of stimulus, right? So that gives you some frontier market boom. That gives you uptick in corporate profitability. You can arrest that decline and maybe get another acceleration out of it. But it seems like if that's not the path they're going to go on, then I do think that the quarter by quarter, I think unless there's a trend change, I think we are marching towards recession. Yes. Growth has been decelerating, and yet it's not been a time to own bonds. That's what caught up a lot of the bond bulls and the disinflationary bulls. They were like, look, over the past X number of cycles, when PMI decelerates, bonds do well. And it's sure, unless you have a record spread between bond yields and inflation, is still a problem, because this is not the last few decades of playbooks. If bonds blow out far enough, and they've already exceeded what I would have guessed that they would have got to this quickly, there's a point where they're interesting, especially the shorter end of the curve. If you want kind of risk off dry powder, and you say the yields are below inflation, but I'm concerned about recession, that can, I think, be a reasonable place to park capital. I'm also cautiously optimistic on gold after it's held up better than the long end of the curve. And I think when there is a liquidity period, I think gold can catch a bid while potentially, say, corporate profits are still struggling. And so you can get a bid in some of these harder assets that don't have margins, the gold Bitcoin spread, compared to something like corporations that even if there's a Fed pause or pivot, they might still have deteriorating corporate earning situations. So stocks might run into issues, right? So there are different kind of things to look out for that. I generally think that as long as we're in this economic decelerating environment, generally stay defensive. For me, it's been less about bonds and it's been more about things like healthcare stocks, energy pipelines, tobacco companies, kind of consumer staple type of things. And I've overweighted that. So I don't do like a fast turnover portfolio where I go all into just these things, but I've been tilting to that direction since the beginning of this year, while still having a barbell approach of some risk assets that I like. Some of them were worked out, some of them didn't. For example, Brazil has been one that I've been overweight Brazil. That one's done quite well. Whereas, for example, I also have a Bitcoin allocation that has been holding up recently pretty well, but obviously earlier this year that's done quite poorly. And so I've been balancing a risk-off, defensive, higher yielding type of portfolio with some degree of inflation protection built in. And then select risk assets. I like India, I like Brazil. Long term, I like Bitcoin, but I keep reminding people that generally in a declining PMI environment, it generally runs into headwinds.